Rory, what are your topics today? What are you focusing on other than quote Cardi B quotes?
Was that to Roy or to Rory?
Rory, Mr. Bamford.
Oh, okay. Cool. One day I'm gonna get those, but I've just been it's almost been like a self exercise with investing because right now you've got all-time highs and like all these stocks, and people love to pile in, drive prices up, like in the popular like AI was a big or has been a big thing this year. So it's kind of still a phenomenon that it's very interesting watching is that as stuff climbs higher in the finance markets, that's when people want to basically pour in, buy at all-time highs. Don't really do any due diligence. Don't really look at the valuations. It's just like this is popular. Wall Street Journal's talking about it. Let's buy it. And when the retail market, there's obviously the investor market, which owns these giant swaths of these companies. But when that retail market comes in, you see it drive a lot of growth in these companies. I use an example. Like you might have something that's 100 times sales. It might go to 200 times sales. Just massive bubbles. Like as an example, if I'm buying a retail company, I'll look at it. I'll start following it. I'm like, oh, it's getting close to 1-to-1 price to sales, because that way I know as it climbs, it should grow over time with the retail sales if it grows. And it's still fascinating to me that in so many areas, like if there's a discount on a car, if you're buying something and you're going to get 50% off, people love that. But when it comes to finance, they don't. They want, and it's probably the due diligence part of it, but it's still a fascinating thing. Like I remember back in March 2020, obviously there was people just dumping like these companies that are like phenomenal companies. So when they're dumping those companies at like all-time lows, or some of them close to all-time lows, and I'm sitting there basically buying as much as I can get, you're kind of looking for those opportunities. But I think that's where the due diligence part of it is if I've been following a company for 10 years, the retail market isn't. Most people, they don't have that time. They've got families, they're running around people to sports, and they got all this stuff going on. And so it's talked about, like all the great investors always talk about it. And it's kind of like when there's blood in the streets, that's when you're wanting to get into those companies, but you have to have done that due diligence beforehand. It's one of the questions I would have to both of you, and this is kind of like off the cuff, but like a regular investor slash saver, how do you plan for those peaks and valleys in the markets? I obviously have opinions on that and like what I do, but I'm just curious on like what your perspectives would be on that if you are going to look at buying into a public company.
I think if you talk to a financial advisor, and the first thing they'll ask is they want to get your risk profile, right?
Mm-hmm.
Which is important. You have to, know yourself is one of the themes of leadership, but you do have to understand what you're willing to risk and what you're not, because investing in the market, there's always risk involved. And, do you want to preserve your, what you've earned and go to a GIC or something very safe? Or, are you looking to double your money? Is it a short-term or a long-term investment? That's probably the biggest question, because if you're just trying to flip it, then you watch the market, you watch the ups and downs, it's all about timing. If you're looking long-term, then it's all about that research, picking the right group, looking ahead. But the question I had for you, Rory, we talk about retail. In the mining industry, most of the investors are institutional, I would think.
Yeah, they are.
Whereas there's other stocks, very popular stocks, which are attractive to individuals and which are retail. And I get the feeling that retail is more about short-term gains. And if you're looking at long-term, you go institutional and you look at diversified portfolio. I'm saying all these words I don't understand, but you do.
What you said about the like institutional, that's a lot of times like the banks, the investment management houses, and of course, a lot of them actually don't beat like the overall market. Like you're better off to just, for the most part, like a lot of people are better off just to buy an S&P 500 index fund. That's low cost, but that can be just a really good, safe way to make kind of your 8 to 12% based on what the S&P 500 does. Top 500 companies in the USA, they're massive. You're getting exposure to all those big companies. But you are right, Roy. Like one thing that was fascinating, like you brought up gold mining. So gold went to all-time highs, and then you start seeing everybody. Like if you go on to like social media, all of a sudden people are talking about gold and gold miners, and you're like, this is all-time highs. Why would you even be looking at this right now? It's coming back. Like it's not going to stay. It's not going to stay at those levels. The actual gold miners get as much out as you can.
Yeah, but you know what? Your comment about social media is interesting because whatever the long-term trends say, if gold is at 2,500 an ounce, for example, somebody out there is always saying it's going to go to 5,000.
Yes.
You know, and that won't be the analysts and that won't be the majority, but that catches your eye. And if you're not risk adverse, and 2,500 an ounce is going to go to 5,000, and you know, you get a certain investor that might be interested in that.